I want to talk a bit about trade wars and retaliatory tariffs. What kind of risks does tit-for-tat approach pose?
So the risks inherent in a trade war are much the same as the tariff skirmishes that led to the war.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast. Brought to you by Trade Finance Global.
Hello and welcome to Trade Finance Talks. I'm Mahika Ravi Shankar, Deputy Editor at Trade Finance Global, and we're coming to you from the 51st Annual ITFA Conference in Singapore. This year, trade journalism has never been more fashionable, thanks in particular to the series of tariffs rolled out by one President Donald Trump. And to tell me a bit more, I'm joined today by Craig Weeks of BAFT. We're going to just unpick tariffs from every which angle we can. Craig, lovely to have you.
Thank you so much for having me. It's an honor to be here.
So please, can you introduce yourself and tell us a bit about your background and your role within BAFT, and also what brings you to ITFA this year?
I've been in trade for about 35 years. I was with some of the big banks, JP, HSBC, Citi, a US bank, as well as a large grain trading company doing trade finance. So this is really in my blood. I joined BAFT about a year ago, and I'm the Senior Vice President for Trade, the quote-unquote subject matter expert.
As such a subject matter expert, I wonder whether you could just give us a concise definition of what a tariff is. It's a term that gets thrown around all the time, but what actually does it mean?
Tariffs are used to raise revenue for the government or to protect domestic industries by making foreign goods more expensive. So there are two types of tariffs. There are tariffs on exports and tariffs on imports. And there are three types of tariffs. Ad valorem, where they're adding an expense to the value of a good. Specific tariffs, where they pick a particular item and add an expense to it. And the compound tariffs, which actually are sort of a hybrid of the two.
Cool, thanks a lot. I know these have been used, I guess, to some political gain, ideological about protecting domestic interest. But from a banking and trade finance perspective, what are the main differences between tariffs and other forms of trade barriers, like quotas or sanctions?
Yeah, so quotas would limit the quantity of a product that can be imported or exported during a certain period of time and are done to directly restrict supply of foreign goods in order to protect domestic industries. It caps foreign competition. For example, a country only allowing a certain number of tractors to be imported from one year from either one country or a bunch of countries, specifically to drive up the cost of that import and make domestic product more attractive. Sanctions are different. Sanctions are broader restrictions and sometimes total bans on trade with specific country, company, or individual, generally used for political or security purposes and generally not economic. People use sanctions to pressure governments, to punish bad behavior, or to restrict access. For example, on a dual-use good, there might be sanctions on exporting certain items that could have dual use in certain countries. So that would be a sanction. So just to put it simplistically, tariffs impact the cost, quotas restrict the quantity, and sanctions restrict who.
Perfect. I feel like that sums it up quite concisely. So with that background, how have the tariff developments from the US this year affected financial institutions involved in trade finance?
I'm going to give you 5 examples of this. First, higher working capital needs and larger credit facility sizes, because tariffs on key inputs increase invoice values, which creates the need for larger credit lines, larger letters of credit, larger pre-ex or import loans, and increases the overall value of supply chain finance programs. So number 2 feeds off of that. That causes increased credit risk with borrowers trying to absorb tariffs, or if they're unable to, then they'll pass them through. That reduces the bank's margins along with the inventory value volatility. So contracts may these days have actually MAC clauses, what we would call material adverse change clauses, that also increases volatility. Thirdly, increased compliant risks due to the need to interpret the intent of transshipments and alternate suppliers, which raises the risk of misdeclarations and misunderstood rules of origin. Fourthly, increased operations risk from heightened documentation checking and compliance requirements and unclear protocols for mitigating these risks. This is sort of new territory for a lot of banks, and they're sort of feeling their way. And fifth, increased expense of insurance premiums, which increases the overall cost of and erodes spreads. So there's not a lot of good news.
What kind of ripple effects do you think these changes will have on emerging markets and their access to trade finance?
Yeah, so we're talking about the trade finance gap here, right? So as previously noted, the impact on trade finance business will, in many cases, have a direct impact on addressing the trade finance gap. So this is impacting most strongly the people who are least able to deal with it, and especially for SMEs in emerging markets. This is specifically due to increased working capital demand, larger financing lines just to fund the same size shipment. The less capitalized smaller banks cannot expand facilities proportionally, so the gap widens. With higher perceived risk, there's an ever tighter credit, so it becomes a vicious cycle, and that causes increased uncertainty about supply chains. Banks respond with stricter credit terms, higher collateral requirements, shorter tenors, and tighter covenants, and as previously stated, this negatively impacts SMEs disproportionately as they are the least able to pass along the tariff impact onto their clients.
It's always the case, isn't it, with any shock to a supply chain that the smallest in the global economy hurts adversely badly. We're seeing it with the climate crisis a lot, where, for example, the floods in Pakistan, where Pakistan are such small polluters in the world, still have to deal with the strong effects of climate change, and it's no different.
Another example would be the big box stores in the United States have been able to absorb a lot of this tariff thing. Now, I think that's coming to an end. They're going to start, that's not forever. They can't do that forever. However, the small bicycle manufacturer somewhere in the United States who requires imports, who can't afford them anymore, he can't then pass on a 50% increase to his clients. He goes out of business. Does anybody really notice or care? Collectively we do, but individually we probably don't.
We reported recently on auto parts manufacturers in South Korea and how quite a few of these small businesses have gone bankrupt recently. It's a story that I had to find digging through the Korean news, and that's where we were able to report on it from. It's just not at all amplified or talked about. So yeah, definitely an important one to bring up.
And not only does it impact the small importers, but also the small exporters, because a lot of them in the United States are using imports to manufacture what they export. They all of a sudden have a huge increase in their inputs that they can't pass along to their foreign buyers. Just imports, it's not. It's on both sides of the equation.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it.
I want to now talk a little bit about anticipation of tariffs, which may well be as dangerous as the actual thing. And I guess in reality, all of the response we're seeing to tariffs is in anticipation. It will only be at least a few months, if not a year or so, before we see the true impact of what more expensive imports could mean. How do you think exporters and importers typically adjust their payment terms or financing arrangements?
So they're not powerless. They have some arrows in their quiver. Among them would be they'll front load inventory purchases or front load shipments, getting it now before the tariff takes effect, making advance payments, reducing tenors, accelerating discounting. The banks need to pay attention because this is going to cause a transition away from letters of credit even more than it was. Letters of credit are expensive. And if you can move to open account or doc collections where it's less expensive because of this uncertainty, they're going to go ahead and do that. Some contracts now are having tariff pass-through language so that buyers pay if the tariffs are applied, or the supplier rebates them if tariffs are applied ex post facto. And it's a case by case. There are some people who would accept that, but that's hard. And wider use of interest rate and commodity swaps and hedges, which is good as long as you have players who are sophisticated enough to understand those contracts that they're getting into. Finally, this is what we're also seeing very aggressively, whether it is, we call it proactive de-risking, moving your suppliers to other countries or changing your customer base from one country to another to get out from under this uncertainty.
How about maybe in terms of stockpiling? Do you see, I guess obviously it doesn't translate as much into payment terms, but do you think that's affecting trade finance and people reaching out for it? Just the tendency of companies to stockpile now.
Yeah, you can do that. And they did that for the first quarter. And now they've run through that. And all of a sudden they have to restock and the price is hugely larger. So their ability to suck that up is limited. And I think one of the big box builders said it, a retailer said it last week. Enough is enough. And pointing to the consumers in the United States, you're going to start paying.
I want to talk a bit about trade wars and retaliatory tariffs. What kind of risks this tit-for-tat approach pose?
So the risks inherent in a trade war are much the same as the tariff skirmishes that led to the war. For example, over and above the tactical issues that we've talked about before, at a high level, you're going to see four main risks. First of all, reduce global market efficiency. Okay, this is a system that's actually worked pretty well. Now with all the uncertainty, do I buy? Do I not buy? How much do I buy? How much do I sell? There's a huge amount of uncertainty, which the markets hate. Secondly, delays or canceled corporate investment and huge procurement programs. Do I buy those American jets? Are they going to be a reliable supplier anymore? I'll put it off for a while. Delayed or canceled programs like that are also disruptive. Fourthly, heightened and difficult to measure operational compliance, legal and regulatory risks from transshipments, rules of origin exposures, customs and duties jeopardy, dock checking, commercial disputes, and so forth. So when I teach about the risk wheel in a trade transaction and the 8 different risks, every single one of them comes out on tariffs. Every single one of them. It's the only thing I've seen that has all of them, okay, present. That's different and that's serious. That's not great. Trade wars inject cost, uncertainty, and compliance complexity into supply chains. The risks and effects cascade exponentially, often onto SMEs. And we've talked about that. It's the uncertainty, I think, that's gotten everybody so upset about this.
Hopefully not all doom and gloom looking forwards. I'm going to end with a crystal ball kind of a question. Do you think tariffs are going to remain a dominant strategy for the next decade or so, or are we going to start seeing a shift towards alternative trade measures?
So tariffs by themselves are not necessarily bad. When they become a blunt-edged instrument, then that's bad. Also, governments, once they have that source of revenue, it's hugely difficult to get them to give it up. I'd say the tariffs went up by the elevator and they come down by the stairs very, very slowly. And that's unfortunate, but it's my thought that now that all these tariffs have been put in place and the government is getting used to that revenue, it's going to be hard.
Do you think that there are some permanent changes in terms of how supply chains have rerouted? I guess we're coming from Singapore, so I'm thinking about India, which has been hit the hardest probably by tariffs, and closer ties within BRICS.
Yeah, I think it's causing countries to completely rethink their strategic alignment when it comes to, who their economic friends are. And it's interesting, BAFT runs a tariff discussion group every 2 weeks where we have experts talk about what's happened over the last 2 weeks and what's going to be happening. We used to think of this in terms of what's the strategy for the next year. Well, we're really talking about what are our tactics for dealing with it for the next 2 weeks. We haven't had really a compressed timeline on this. And the things that are starting to bother the banks about this are how responsible are we for spotting somebody who might be evading a tariff? Is a letter credit technician somewhere in a branch supposed to be able to see that someone has jacked up their fuel price or their freight price by enough so that they can keep the invoice value the same and that's not hit with the tariff and put all the extra expense into something else to avoid tariffs? How responsible are banks to find that? And they're not getting any kind of direct answers from the government. It's kind of a frightening position to be in.
Yeah, I guess the point being how fraud is evolving around tariffs and you're finding new loopholes in these systems that you can exploit. Anyways, exciting times, maybe dangerous times, but thanks a lot for joining us today, Craig.
Thank you for having me. It was an honor to be here.
Of course.